Good morning, everyone, and welcome back to the Daily Market Brief. Today, we're lifting the lid on a story that has been quietly shaking the foundations of global finance. How leveraged hedge fund strategies had become both a crucial buyer of U.S. Treasuries and a hidden source of fragility in the world's most important bond market. Over the past month, the sell-off in Treasuries was so violent that it forced President Trump to soften his newest tariff push. But behind that political U-turn sits a second, less visible force: highly leveraged relative value trades run by a tight club of macro and fixed income hedge funds. Let's start with the mechanics. The classic trade is called the Treasury basis trade. A fund buys a cash Treasury bond, shorts a Treasury futures contract, and pockets the tiny spread that exists between them. Because Treasuries are deemed risk-free collateral, banks in the repo market will lend against them at extremely low margins, often allowing 50 to 100 times leverage. That means a 1 basis point price difference can be turned into a double-digit annual return. When markets are calm, this leverage supplies liquidity and holds Washington's borrowing costs down. Hedge funds currently hold roughly $1 trillion of Treasuries, about as much as Japan's central bank and more than China's official reserves. In other words, they have become an indispensable part of the government's funding machine. But there's a flip side. When volatility spikes, say, after a weak auction or a shock policy, headline repo lenders demand more margin. Funds have to unwind quickly, dumping bonds and buying back futures. The same leverage that amplified those steady profits now amplifies losses, and liquidity evaporates at the very moment the Treasury market needs it most. That's exactly what happened in early April. Tariff headlines pushed investors to demand higher inflation compensation, yields shot up, and margin calls rippled through the basis trade community. The sell-off accelerated until the White House partially reversed course, fearing a full-blown funding crisis. We've seen this movie before. In March 2020, COVID's dash forecast triggered a mass unwind of basis trades. In 1998, long-term capital management almost imploded under the same strategy, forcing a Wall Street bailout. Today, the positions are larger, and the Treasury market is twice the size it was a decade ago. Regulators know the risk. The SEC had drafted rules to push more Treasury trading into central clearing and to treat highly active funds as registered dealers, measures that would curb leverage. But legal challenges and industry lobbying have slowed implementation. In the meantime, the market must rely on the self-discipline of hedge funds and the reflexes of the Federal Reserve. So where does this leave investors? First, recognize that Treasuries, traditionally the sleep-at-night asset, can now experience air pockets when leverage is forced out. Pricing anomalies can emerge quickly, and risk management frameworks need to account for that. Second, remember the bigger picture. Hedge fund liquidity keeps borrowing costs lower for taxpayers, but at the cost of episodic instability. Policymakers must strike a balance between restraining leverage and keeping the market attractive to private capital. Finally, stay alert to funding market indicators, repo haircuts, swap spread behavior, and futures positioning data. They're the early warning lights for stress that can spill into every other asset class. The bottom line: leveraged hedge fund trades have become a critical organ in the body of global finance, one that pumps liquidity in fair weather but risks cardiac arrest under stress. Understanding that dual role will be essential for navigating the next chapter of market volatility. Thanks for watching the Daily Market Brief. If you found this deep dive helpful, hit subscribe, share it with a friend, and let us know in the comments whether tighter regulation is the answer or whether the market should simply live with this new reality. See you in the next episode.